Caller on the line waiting for some advice. Carl from New South Wales. Carl, what's your question for Michelle Pearce and Daniel Bassi?
My question is about self-managed superannuation funds. I've got roughly about $100,000 in a superannuation fund that I've earned from working for an employer in the past. If I was to set up my own self-managed superannuation fund under a company that I now operate, can I invest that superannuation money into my investment property?
Wow. Okay, that is a complex question. Do you have any more questions at all for Carl, or do you?
I was just going to. Well, we can both answer it. I think because it's big enough for that. In relation to the investment, using your superannuation fund money is the first thing you need to make sure. Well, I suppose there's a couple of questions I need to get through. Firstly, if you've got $100,000 in your super fund, most people these days suggest that you shouldn't set up a self-managed super fund unless you've got about $250,000 to $300,000 in it. The reason for that is really about the compliance costs that go with it, and now also the more stringent regulations around trustees. So you need to be aware of all of that first, from a first perspective. The second issue is in relation to investing in the investment property, you'd have to look at the sole purpose test, which is in relation to the SIS Act. So you need to make sure that investing in that property is for retirement purposes and you satisfy all those rules. There are also rules about trading with essentially the members, and which would be this case. You're okay with business real property, but when you've got a residential property, then you've got issues there and you prohibition of actually doing those sort of trades.
Okay.
So, and also if that particular property is also encumbered, so it has a loan on it, again the superannuation fund would have issues about investing into that property as well. I suggest you go talk to someone. Really, it's quite a big issue.
Very complex question there. Another caller on the line, Paul from Sydney. Paul, what's your question for Michelle and Daniel?
Good evening. I've purchased units in a managed fund since 2001. And over the past 12 months, some of those units have decreased in value. And I just was going to transfer some of the units to my superannuation fund to my own name. And I wondered whether I can actually select just those units in that fund that I've purchased over the last 12 months that I've made a loss on to gain a deduction in my name to transfer to the super fund.
Yeah, interesting one. Would the ATO be looking at that closely? What are your thoughts on this?
Generally when you look at units and the order you purchase them in, generally it's a first in, first out type of rule. In other words, the ones that you bought first are the ones you sort of sold first. I'm not sure you can be as selective as that. But I think
the losing, yeah,
just pick all the losers and move those on. I'm not sure how the tax office would feel about that, but it's normally been a first in, first out type of rule.
Right. Okay then. All right.